Welcome everybody, good afternoon. Welcome to our quarterly market update. My name is Joe Stapleton, president and co-founder here of Spinnaker Investment Group. We appreciate each of you making the time to be here. Today is all about having a meaningful dialogue about the investment markets and our philosophies about investing. We have over 100 clients and prospects and friends and relationships within the Center of Influence and others that are going to be here with us this afternoon. We're also going to record this, so we'll send out a link afterwards. So we can post this on our YouTube channel so you can share it and watch it. And if you miss something, you can pick it up then as well. But for us, education is all about knowledge, and knowledge is all about understanding, tuning out the noise and what's going on. We feel that an educated client is a lifelong client. So for us, that is the motivation and the desire when we put these together, is really keep everybody involved and informed of what we think is going on in the market. So we are celebrating our 5-year anniversary in 2 weeks. So on May 6th, Spinnaker is going to turn 5 years old, and it's remarkable. It's incredible to think where we've come. We founded Spinnaker on the principle of improving the overall client experience. So we couldn't thank you enough for all of your support and help to help make this 5 years happen. So today we continue into 2021. We're managing just over $430 million as a firm. This would not be possible without the support of our clients and certainly our valued partners. And we continue to reinvest in technology and platform and certainly planning tools here at Spinnaker. So today, the format of this afternoon, we're going to be talking about vaccines, vast sums of money, and vacations, right? So we're going to talk about U.S. international stocks and bonds, talk a little bit about interest rates, economic trends, market conditions, and certainly opportunities that we see out there. So there's a Q&A and chat feature at the bottom of your screen. So if you want to chat, you have any questions as we're going through this, please let me know. The reality is we want to have this to be a working dialogue, so you can ask Morgan questions while he's going through it. So if you have something, we can put that in the chat feature of the Q&A, and I'll get to it while Morgan's speaking. So joining us this afternoon is also our Vice President, Andrew Prongold. He's going to, at the end, he's going to talk about probably the most important lesson we can teach you. So certainly stick around for that. Things are reopening. We're having clients back in the office, and we're excited to see you at our next quarterly meeting. So with that, the moment you've all been waiting for, Morgan Kristen, our partner here at Spinnaker Investment Group, CEO and Chief Investment Officer. He runs our investment committee. We affectionately call him the Wizard. He's a CFA, CFP. He's got over 27 years of experience here in the investment world. So with that, I want to give a warm Spinnaker welcome to Morgan Kristen.
As Joe said, we're going to be talking about the market, what happened last quarter, what we think things look like going forward. So to start off, let's look at last quarter. So the quarter that ended March 31st, we saw a pretty good year, or pretty good quarter overall for stocks, starting with the S&P 500, very tech heavy. It was up about 6.2%, but you'll see there too that the small cap stocks did actually quite well. So those are some of the smaller stocks as represented by the Russell 2000, up about 12%. International markets did well. Bonds suffered a bit. We had interest rates, and we'll talk about this more later, but interest rates went up a bit, and that certainly affected valuations in bonds, although high yield bonds did okay. And then we saw commodities go up, and interestingly enough, that really wasn't driven by gold. It was things like energy, and we're going to talk a bit about that. One of the V's that Joe just mentioned was vacations, and certainly we're seeing the price of oil and gas move up. And then real estate investment trusts have moved up, certainly coming off a very poor year last year. They started doing better, but and we'll get into that in a bit more detail in the following slide. So looking at the world market performance, this is looking back from March 31st, 2020, all the way to March 31st, 2021. And what you'll see is kind of a steady climb. So we started out this 1 year period with about a quarter of the US market just idle, just completely shut down. And that March period, March was basically the low of the market. And then it just staged its steady move forward. We hit around, before December, maybe October area, we hit about 30,000 on the Dow, and then we finished out the quarter over 33,000 on the Dow Industrials. World asset classes, the leader was those smaller stocks, small cap stocks, especially the value stocks. So value stocks have underperformed growth for some time now, but certainly made one heck of a move in this first quarter. Then you'll see large value, which is a Russell 1000 there in third. So value is starting to make a move. We're seeing a rotation from growth to value. Then you see at the bottom there, the bonds were off, interest rates went up, and then of course the Treasury bill, which is cash essentially. That's call it zero. That's why money markets are low. That's why your savings account is low, because Treasury bills are very, very low. U.S. stocks. So drilling down just in the U.S. again, the talk was the rotation from growth to value, and especially the small value, which had a great performance in the first quarter. But what I also like you to look at too is that 1 year, those 1 year numbers there also, some very good moves in the 1 year period. Granted, you would have to pick that perfectly. Started April 1 and invested all the way up until March 31st, 2021. However, those moves were pretty substantial. And then as you look out in the 10-year period too, still pretty substantial. The reason why I'm talking about 10 years as well as 1 year is that we're going to talk about a few metrics here where, even though we see a lot of investors coming into these markets, there's quite a few people that have really missed out of these last couple of years. So we've had a lot of bouncing. We've had some moves up and down, some pretty dramatic moves last March in 2020, but overall, returns are pretty good. Now looking at international markets. So when we look at international markets, if you look up here, you'll see that we have it in basically the international markets currency, as well as when you repatriate back to the dollar. So if you were an international investor, you did well when you held it internationally, but as US investors, we did lose a bit of that because of the dollar and how it moves against other currencies. But when you invest internationally, basically you have two ways you can have risk, but also you can have return. One is the overall performance in the index or the stock, and then also the performance of the currency. So if someone believes that all this debt that we're bringing on in the US could hurt the dollar, well, then that would, you may look at some international securities as part of your portfolio. But I'll also look at, the 10-year here. International markets, while in the 1 year, they have done quite well. Not so impressive over the 10 years. They've had a tough time over the last 10 years, unlike our US markets. Basically the same story in emerging markets. The currency added to the value for international holders and certainly impaired a bit of the US holders. Albeit though the returns weren't too bad. Year to date, still the talk over there is small cap. It was value both in the US, international, and emerging. But 10-year not as impressive as some of the other markets, especially in those like the US. So looking at select markets, this is why we look at markets beyond the U.S. If you look about the middle of the chart here on all the developed, you'll notice that the U.S. is about in the mid-range for last quarter. We had some other countries at the top, and then of course we had some countries at the bottom. However, the U.S. fell basically in the middle there. The same thing in emerging markets, Saudi Arabia. You'll notice a lot of those countries at the top there were oil-based. Oil countries did quite well. The returns in some of those and some of those at the bottom, of course, did not do as well and less tied to oil. Currencies, basically almost across the board in the developed as well as emerging markets, we saw that the dollar strengthened against a lot of those currencies. And so quite a few of them underperformed for the first quarter. Real estate investment trust. So this is an interesting area. So very impaired a bit last year as everyone was staying home. The big thought was that no one's going back to their office buildings. And I think a lot of companies have probably graded and gotten rid of some of their space. However, real estate investment trusts are not just office buildings. They're apartments and hospitals and malls and all of that. So we saw a nice comeback in the so far this year, 10%, but the 1 year numbers also look quite good. And then also if we look in the 10-year here, nice steady rate of return in this space. So we're not completely running away from this area. There are some REITs that do other things beyond just commercial real estate, and it's usually a good diversifier. And also, if your belief is that we're heading to inflationary times, it's a good area to be invested. Commodities. The interesting thing here, you'll see gold at the bottom. However, obviously a lot of oil lean hogs and soybean oil, a lot of different oils at the top. So oil really led the quarter's return in commodities. And so I say interesting that gold is towards the bottom because the belief was that some inflation was coming and we would think that we'd get a little more of a push in gold prices, but they did run up to that point. So I guess they're letting off a little steam, but certainly oil led this. But you'll see also in over the last 10 years, not a great place to be invested. You would have lost consistently over 6% per annum if you were invested in commodities. Now, this is looking at a basket of commodities. You can certainly pick one or many and do different performance, but looking at a basket like this, not a great place to be invested over the last 10 years. Global fixed income. So interest rates, like I said earlier, they did move forward. They moved forward in just about, or moved up, I should say, in just about every market. So the US, UK had some basically zero rates up to, I don't know, 7 years. And you see that shift from gray to blue, now, positive across the curve. Then when we look in Germany, they were almost negative yields across the board in gray there. And now they are at least, starting to get positive after 10 years. Japan went absolutely nowhere. Japan is interesting because Japan is kind of a litmus test for where we're going. We're trying to stoke inflation. They haven't been able to grow their economy. So it'll be interesting to see what happens there. Canada, we saw some movement, and then also in Australia.
Hey, Morgan, Beto is asking, certain international countries had great performance. Would you push those markets in Q2 or Q3?
Would I push them?
Yeah, would you be buyers in them?
I would be a buyer internationally, just looking internationally, not those specific countries. Reason is a lot of times the top one goes to the bottom. You see it does well, it gets over allocated and it drops back. So as a contrarian, I'd probably look to those that didn't do as well if you wanted to look at a specific country.
Terrific.
Fixed income. Pretty dramatic move when we look at not only the end of last year, but all the way back to March of the following year. That's a big shift. Granted, rates are extremely low, but that's a pretty big move. When we look at that chart over there, you'll see we have the 10-year, those numbers there are basis points. So 100 basis points means 1%. So those are basis point moves in those different bonds. So a 10-year bond moved almost 1%. That's a dramatic move, and that spooked the markets. It certainly affected fixed income markets. And the reason why I say this is that it's certainly, when we look at this chart, we're not even back to where we were before the pandemic. And we're certainly nowhere near where we were in 2018. However, that's a pretty big move. And you talk to anyone in bond pits and they would say that's just an amazing move in such a short amount of time. Almost 1% in that amount of time is just, I hate the term unprecedented, used too much, but it's a massive move. And so what does that impact, or what does that affect? Well, the value. So if you look at the value of bonds, there's an inverse relationship. So in blue, that's the rate. So interest rates start moving up and values go down. So almost overnight, some bondholders started losing value in their portfolios because it was such a quick move. Almost a 1% move that quickly caught a lot of people by surprise. It's more, the impact is more pronounced the longer out you go on the yield curve. So someone with a 30-year bond, assuming a 1% increase in yields, they would have lost 19% in the value of their bond. Now, you can hold it to maturity and you don't lose anything. That just assumes that today, if I was to sell that 30-year bond that doesn't even have a spectacular yield, I would have lost 19% overnight. So when you invest in bonds, you have to understand your maturities, your durations, all those different things. Because if you assume the interest rates are going to continue going up, you'll see that bond values will continue to go down. And it's going to be more and more pronounced the further out your bonds are. Now, the Fed has basically said they don't believe that the economy is at its full capacity yet. Remember, the Fed has two things they need to do. They want to look at full employment and they want to look at inflation. So when you look at that, they don't believe we're at full employment, which we aren't. We still have quite a few people that are not working. But they also said they don't see inflation as a problem right now. Inflation has moved up. However, and it could continue to move up because of supply chain issues. Look off the coast right now. There's a bunch of boats sitting there. And so there's certainly some issues, chips. So we could continue to see it. However, at this point, the Fed doesn't see any issues with it. And so the Fed is really holding steady with their basically 0% interest rate. That's a short-term rate, and they call it the overnight rate. So the Fed is not moving at this point. And, we look here, this in blue is where the Fed rates are. So, we look back and they had they started raising rates back in the day, then it went flat for many years during that recession. And then they started going up again, and now we're back flat. And so the dark blue line is basically the market. So the market is saying, I don't think so. So the Fed can put their rates where they want, or the market can decide to go somewhere else with it. And you'll see in orange there that the implied interest rates are starting to move up a tad. So the Fed is staying zero, right at that zero limit. In fact, they said 2023, probably not changing anything till 2024. Obviously that could change, but that's why that's a pretty, you could look at the yield curve and it's pretty flat on the short end. So let's look at the market health. How are we looking as far as the market, the economy, and all of that? This big chart here is basically an asset quilt. So what are all the different assets doing going back 1 year? So starting in April all the way up to the end of March. And really what it's showing, you don't need to know all the particulars, but what we want to see is that movement of color, meaning sometimes energy's up, sometimes materials are up, but we want to see some movement. A healthy market doesn't have one sector dominating it. Now, last year we did have some domination for a while in IT or technology, but we also had it in materials and industrials, interestingly enough, because people started betting on certain areas. So that to us looks healthy because of the movement with and around different asset classes. The GDP forecast. So the forecast is for about 6.5%. And as you'll see there, we haven't had that since 1983. So that looks pretty good when you look at a GDP forecast like that. Granted, it's from a very low number, but that's a pretty hefty number. Not sustainable, but as we forecast out, that's a good number. Restaurants and TSA. So in black, we're looking at restaurant usage. We're seeing that move up. We're also seeing airlines getting back. People are getting back on flights. That other V that Joe mentioned earlier, vacations. So people are getting out there. They're looking for flights. So we're starting to see TSA tracking going up. That's going to be your scale to the left there, the millions of people, and then on the right is restaurants. So we're not back at 100%, but we're certainly, the trend looks very good, and that's part of this opening trade where people are saying, hey, people are getting vaccinated, things are opening up, we're starting to see people move about. Our PE ratio still a little bit high. So the top chart there, we're above a normal rate, certainly high. It's trending down a bit. It is still lower than where it was back in the tech crash, but still a high number. A good part of when you look at the S&P, it is part of it is tech stocks, which are certainly expensive out there, but it is still a high number. But when you look at the earnings yield, it is somewhat attractive. So basically, you're taking what's the yield on the S&P, taking it from a bond rate, and so looking at where bonds are today, a 10-year bond at a 156 versus a basically close to 2% yield in the S&P 500. You look at it that way, and stocks still look fairly attractive. U.S. households, our debt, we continue in yellow or orange, whatever that color is there, we continue to trend down, which is nice. So we're taking on less and less debt at this point. Our savings has dropped a bit, but still pretty high, substantially above historic numbers based on where we've saved in the past, all the way back here till 2006. And then, we're kind of still in that optimistic zone. Investors are very optimistic. That's a Not a great look for the market. So we do like to see it kind of pull down there where people are a little more pessimistic about the market. It's more of a contrarian indicator, but it's something certainly to watch. U.S. equity purchases by individual investors. We're seeing this trail off a bit, so it's slowing down, and I'll get into that a bit more later and why this is, it could be good for the market, but it's trending down. But I would also point to this part of the curve here, our chart. If you look there, really, U.S. investors haven't been investing in stocks in a long while. What you'll see here is that the U.S. investors have not been investing at really to any level that they have in the past. What do we got there? And we'll see that in this next chart here. So when you look at this chart, you'll see the inflows over the past 5 months versus the prior 12 years. So interestingly enough, the past 5 months, there's been $569 billion going into equity mutual funds. And those are global equity mutual funds. Now that number is higher than the last 12 years, which is a pretty amazing number there. So in other words, the last 12 years, people really haven't been investing in the market. They put in numbers that are not nowhere even near where people have done in the last basically 5 months. So that's a pretty astounding number. And a big part of that, I apologize here, we're kind of losing a little bit of the screen here as we're waiting for our lights, but a big part of that is that we have a tax refunds. We're not even just tax refunds, but we also have stimulus. A lot of stimulus is going into this economy, a tremendous amount of stimulus. So a lot of money's flooding into this market, which is certainly helping savings rates. It's also saving people, but it's also going into markets and going into other things, which we'll touch on in a bit. Now, when you look at also cases for COVID cases are going down. There were some reports out today from Orange County, and the numbers look pretty good. We're continuing to get better. Now, this is a U.S. phenomenon because you look in other countries, it doesn't look as good. So we're seeing cases go down, but in the light blue line, we're seeing mobility go up. So people are getting out, we're moving around, and so that's certainly a great thing to see. And the CPI, so it's Consumer Price Index, these things are looking a lot, you look at it, it's pretty flatline. So, we all know that there's things that are certainly inflated out there. But when you look at traditional metrics like the Consumer Price Index that the federal government tracks and the Fed tracks, those numbers look pretty good. They've been pretty flat. And then if you look at our LEIs, leading economic indicators, what a snapback. I mean, that snapback has been phenomenal. Really a quick return there. If you look at our prior recession, it took almost 10 years to get those numbers back. So leading economic indicators, one of the leading economic indicators is actually the S&P 500. So, that certainly has helped that snapback, but what a quick return back to those numbers. Traditionally, after a recession, it doesn't come back that quickly. And then, of course, we have the Biden infrastructure plan, and there's some infrastructure. There's a lot of different things that are in it that are going on with this plan that are beyond just infrastructure. And basically, when you look at how plans like this go, there's a decent amount of pork in it. So we'll see. I mean, there's a lot of money out there, and there's a lot of money going into this economy. And that was the other V, vast sums of money. There's vast sums of money going into this economy. And this is a pretty massive plan right here. Okay, so the good. What is looking good in the market and economy? What we just talked about, market health. What looks good overall in the market? Let's talk about the health. Money supply. We showed the chart earlier. There's stimulus, tax returns, all this money is coming in there. And I'll also point to right here too. See that number? It's been slowly moving up, and it really trends back to that earlier chart of 12 years. People really haven't been investing in the stock market, but over those last 12 years, a lot of people have been saving. But then you see the massive spike, almost $3 trillion spike. So this is money market accounts, savings accounts, and checking accounts. There's a tremendous amount of money sitting there that this number will come down at some point, but that's a lot of money that has a lot of buying power.
Volatility. So, we've had some spikes certainly, but right now volatility is extremely low. Reopening stocks. So if we look from last year, we had the trend where stay-at-home stocks did quite well. Peloton, Zoom, a lot of those did well. But now we're starting to see that opening, the reopening trade. People are looking at airlines, hotels, and all of that. So we're seeing that shift. That shift is also that growth to value shift. And you see that like in banks. Banks haven't done well, and all of a sudden banks are up pretty substantially. And it's really not a big surprise because banks put a tremendous amount of money in loan loss reserves. They are holding back a lot of money because they're anticipating a flood of bankruptcies, a flood of foreclosures, people losing their homes. But what we're seeing now is that the government came in, put that safety net in. And so now it looks like a lot of these banks are going to be able to take these numbers, turn them, and now create profit versus what we see here in these loan loss reserves. So it's certainly helping some of the bank stocks. So the bad. Can I stack my stocks with NFTs? So these are all new terms we've all heard of lately. So let's talk through a few of those. We have some speculation. So a short list of speculation. We're going to talk about crypto, NFT, and SPACs, but also trading cards. 7 of 10 most expensive trading cards have gone in the last 8 months. We see it in sneakers. So things are, really money is going into a lot of different areas. Bitcoin. So Bitcoin is really shot up. I mean, this thing is just really, to use some of the Reddit, Wall Street groups, that, to the moon. This thing has really gone to the moon here. It's really shot up. So Bitcoin, though, has some legitimacy to it. There's a lot of companies that bought it. They're, allowing it to be traded for cars and various things like that. So there's some legitimacy. But there's also things like Dogecoin. Dogecoin was actually a meme. My kids told me about Doge many years ago as this dog. And so then they turned it into this coin. So there's actually nothing to this. It was made as a joke. And now here we are with this thing, I think today trading about 31, 32 cents. They're trying to shoot it up to $1 last week, and they just didn't, or into this week, just didn't get that done. But, these are some of the kind of joke coins out there. Today, there's over 9,000 crypto coins. That's an amazing number because they are actually, that's larger than actual stocks that are out there for sale today. So they're more crypto than there are stocks. And there are some crypto that make a lot of sense. What's their utility? What are they doing to change the world? So there's a lot that makes sense. Some are looking at the supply chain. So certainly when you look at these, there's a lot of them out. With 9,000, that means there's probably, I don't know, 850 that are kind of bogus and they're just kind of grabbing at your money, but there are some that'll make sense. I mean, this is kind of the future, and you see it in this chart here. Digital payment transactions are going to continue to move up. We're seeing it internationally a lot more. Asia Pacific uses a lot more than we do. However, that's going to continue to be a trend, and I think that'll just keep moving forward. So there are, certainly some legitimate cryptocurrencies. I think it's tough to call some of them currencies, but I think a lot of these companies actually are listed. I would treat them more like a stock versus a currency. NFTs. So people sold this painting, or whatever you want to call this, sold this for about $70 million. So someone now owns the right to have this little piece of the internet. Prior to that, he hadn't sold anything for more than $100. Because of this, I started working on my own NFT. I'm working on it, and so just message Joe later, and I'll start taking bids when we're done with this. Now SPACs. So these are these special purpose acquisition companies. So when you look here, traditional initial public offerings, IPOs, take 6 to 12 months. Yeah, you go through underwriters, they make a lot of money. And then you come public. Well, SPACs have really taken off. In fact, there's more this year so far than there was all of last year, as you'll see there. So that's a pretty amazing number. So what these companies do is they come out at $10 a share, they raise money, they don't even have anything that they're offering yet. They're going to merge in, purchase some kind of company. Interesting to notice some of the things up above there. There's 3 electric vehicle companies. And so an IPO, they look at what they've done in the past, they look at some of those numbers. The SPAC, what they'll do is they'll project, they'll make some projections. So there's 3
electric vehicle companies that are assuming they're going to have 10 billion in sales within 3 years. So to put some context on that, it took Google 9 years, Facebook 11, Tesla 11, and Amazon 12 years. So those are some massive hurdles. So we're starting to see SPACs pull back a bit, and I think it's rightfully so, because I think some of these projections are just a little bit out of control.
And Morgan, we've got an anonymous attendee who's asking, should he bet the farm on GameStop?
Negative.
Negative.
Yeah.
And however, though, obviously someone's making money in SPACs, and that is the banks. The banks are they're underwriting like crazy. There was articles out, I think last month. These Goldman folks were just tired. They're overworking them, and so the banks are absolutely killing it on these. So another thing, the bad is this debt. So in the blue line, you can just see, we are taking on a tremendous amount of debt, and that is certainly that's a pretty scary number out there. Obviously, going back to many years, in the 70s and all that, we haven't seen those kind of numbers, at least in this chart, ever. Jeffrey Gundlach, a bond manager, had an interesting tweet the other day. He said, "Did you know that 57% of the federal government spending over the last 12 months were unfunded?" So each dollar that was spent, 57 cents was deficit spending. So that, with the way we're currently going, it's going to be about 80 cents on the dollar that is deficit spending. So he says, why not make it 100 and just forget about taxes? So basically the point of this is, the taxes are somewhat irrelevant. We don't have an income problem. We have a massive spending problem. And so that will need to be looked at. We've lost all the deficit hawks. No one's watching any of this right now. We're just spending. So any conversation or talk about taxes tends to be a bit more political, rather, because if you look at it here, we're certainly not plugging any of this problem here. We're heading towards Japan, which is certainly spending more than their gross domestic product. So that's something to be watched. That's something that we don't consider to be too great. Investors are borrowing a ton against their portfolios. So margin debt. Basically, you can borrow 50% of your portfolio and invest more. You may have heard about Archegos, which was a family office. He had leverage way beyond that. Somehow they allow hedge funds and other people to invest a lot more than us little people, but he was 8 to 20 times leverage. So he took $20 billion and quickly turned it into zero. So it works for you when it's working, but it certainly works against you. So this is of concern because it's so easy to get margin nowadays. It used to be something you had to work a little harder to get. So we'll see. And the reason is those numbers earlier, when we saw so much money going into the market, we have a lot of newbies, a lot of people trying margin, and they haven't really been tested in a downdraft. So that's of concern. And of course, the job numbers. This is interesting to me too, because we have a lot of people jobless, but right now there are more job openings than there are jobless. So we have a major disconnect here, and that's because the government just keeps giving money out. There's, I think, American Airlines had to cancel a bunch of flights because they couldn't get pilots back. Companies are giving incentives for employees to come back. So it makes more sense for some of them to sit at home because they're getting a check from the government. So this will need to correct itself, obviously. And I think a big part of that will be once we stop giving money out and when this economy starts turning, or just in general, stop giving money out. Subprime auto borrowers who are more than 60 days late. The reason why we look at this is usually this group, this is the last thing they go late on. They do not want to lose their automobile. It's one thing if you slow down on a credit card payment, various things like that, because you can stretch that. But we watch this because this is, again, the last thing that usually happens. And especially when some of these folks probably have rent moratoriums and all of that. So this is of concern, something certainly to watch. I will say real quickly on auto loans too. Used cars have gone up quite a bit because there's a lot less new cars, so prices have gone up. This is another one. So David Einhorn, he is a hedge fund manager. He found this stock, Hometown Deli, HWIN is the ticker. So this company has a market cap of $100 million. And this company is one deli that had $35,000 of income over the last 2 years. Mania, I would say for sure. This is definitely craziness. I don't know how this has happened. And then also, this is Europe. We are looking great as far as vaccination and COVID numbers. Europe is not.
They did a great job at shutting everything down, and they've done a horrible job at getting the vaccines out. Now they just J&J's back up and running out there. So these numbers will have to improve for the world economy to continue going. Ours looks great, but we'll need to see some improvement here. So let's wrap this up. So the 3 V's. So, Oprah was giving away cards, but now it's shot. You get a shot, you get a shot. So everyone's getting out there and getting their shots. They say that about 50% of US folks have at least one shot. So that's good news. Are we hitting some kind of herd immunity? Did more people have it than actually we knew? So things are looking better. We're opening things up. Here in California, it sounds like March 15th, no restrictions. I'm sorry, June 15th, no restrictions. So that's good news for us. Vacation. So now you look at the terms that are Googled. It's no longer meme stocks. It's no longer GameStop. It is now airlines and hotels and vacations and cruises. So people are taking that large sum of money that they saved over time, and now they're going to start deploying it, going on vacations, getting out there. We see that in the TSA numbers and all of that. And then all this money, vast sums. The government just continues to push money into this economy. Now, at some point, this has to stop and people need to be weaned from this, but right now it's out there. So these 3 things we think allows this year to be a decent year in stocks.
So when you look at dosages, these dosages across different countries.
Yeah, we talked about this a bit last quarter. So the winners and losers. So areas that are continue to look good are travel. So we're seeing that some of those stocks look better. We're seeing it in restaurants. People are going back out. That we know a lot of restaurants will go under. However, we're starting to see people back, and restaurants are opening up. And so energy, if you look over here, energy because of people traveling, getting out and doing things. But also up above in green, an area that we think will do well, and I'll get into it in just a second here. Healthcare. Healthcare will continue to do well. And like telemedicine and all of that.
You look at the remote monitoring, they're
Expecting about a 29% per annum growth in that area because we're seeing it more and more. So that's technology, and it's merging with healthcare. And then R&D spending in pharmaceuticals, that just continues to grow and will continue to grow.
So ways the pandemic actually will make the world better. This
mRNA, the messenger RNA that is in the Pfizer and the Moderna vaccine is pretty amazing. And that is, it can really target the cells. So when you start thinking about cancer, when people get radiated, it kills the good, it kills the bad, but now they can actually target things. So messenger RNA will make some major changes and major implications for future generations. There's what's called the solo paradox, and that is, something comes out and it just doesn't take off right away because we have to digest it, understand it. It's basically a J curve. So that long flat part and then the J part. So we've actually accelerated that, and that because we were forced to learn the digital infrastructure. Docusign, everyone's Docusign, probably done some in the past, but now just about everything's Docusign. Zoom, like we're doing today, everyone understands how to work that. And then telehealth. If you had any kind of meeting with a doctor over the last year, you probably at least had an initial call on your phone or on your computer. So it's amazing, some of those things and where they'll go. Generational, millennials are now entering their prime. Basically, prime spending peaks around late 40s. They're actually a larger generation than the baby boomers. And if you remember the 80s, it was a good time in the economy. Baby boomers were known for keeping up with the Joneses, the excesses out there. You can also blame the baby boomers for minivans and these giant houses we all need to live in. Millennials are what they call the echo boom. They're a bit more frugal, but they are getting out there and they're starting to spend. The economy, American Airlines announced it expects summer travel to hit pre-pandemic levels. That GDP growth, 6.5 is pretty impressive. And then, basically money getting out there, it's going to unleash the beast. People are getting out, traveling, doing things. Speculation is slowing a bit. We're seeing on the New York Stock Exchange, we're seeing volumes come down a bit. Those NFT prices have fallen. And meme stocks are flattening a bit, and those SPACs are taking a hit. We're seeing some of those really come back down to earth because people are realizing, like, well, what am I into here? And finally, so the investment implications, interest rates will be lower for longer. So bonds, they do fit in a portfolio, but they may or may not be as safe as you may want. So someone who needs income, you may want to look at some alternatives there. Less office space means less capital needed. That's good for a lot of companies and their growth. They don't need all that office space. Certainly that's a line item they can take off. Inflation is going to spike in the short term, should subside, but then what? What will we see after that? Is this current inflation transitory, or is it going to be more long term? We'll see. But costs are definitely moving up. You see that in gas, staffing, all these incentives. It's going to flow down. Procter & Gamble and Coca-Cola announced yesterday that they're increasing prices. That's supply chain things, various things like that. So prices are going up. And again, across the board, we see prices going up in most things. Savings will drop, so that wonderful number we have in our money supply is going to come down because we will start spending. It's good for the economy. Housing is going to be strong because there's just a lack of inventory and rates are very, very low. What I'd watch for, though, is that rent and mortgage moratorium. Just because I don't have to pay my mortgage today doesn't mean that those payments aren't tacked onto the back of my mortgage. So watch for that. Some of the folks with rent, now that California, it's almost impossible to kick someone out of your property, but at some point you're going to be able to move some people out, and so that'll be interesting there. Boredom going to set in, and it's going to hurt meme stocks, possibly. I mean, the fact that we're already seeing a slowdown in trading tells me that people are, we're not bored at home trading a bunch of stocks. We're now starting to venture out. That rotation to quality will continue. Earnings matter, dividends matter. They always have. So there's a concern that this market pulls back. Generally, those that hold up well are those that have earnings. Good old companies that pay dividends, that grow their dividends. Those are good, solid companies and always should be a part of your portfolio. Healthcare looks good for the future, but it's also fairly valued. It hasn't spiked like other areas. So it should be a good year in stocks, less so for bonds. And as Warren Buffett said, someone's sitting in the shade today because someone planted a tree a long time ago. So I say that because in the past, there weren't a lot of investors in the market. Most people stayed away from it. They didn't invest. They didn't get in it. So will this continue in a straight line? No, most definitely not. However, it is, you can't sit in cash at this point, and you can't chase some of these high flyers. Planting those seeds, building, adding to a portfolio, we always believe is a good way to invest. Joe, back to you.
Terrific. Thanks, Morgan. Roy Fox, he's asking, he said, there seems to be a lot of unclear news on the chip shortage and its effect on supply chains. What's the rational short-term expectation? Before you answer that, just let everyone know, all the participants that are joining us, please, you can raise your hand in the feature below. You can put a chat together or write a Q&A and we'll get to that. But go ahead, Morgan.
Yeah, I that's a great question because it definitely impacts a lot of different areas and sectors. I mean, look at automobiles. I mean, Toyota figured this out a while ago when the tsunami came through. They decided to figure it out on their own, and so they're not as impacted. But it's going to have a big impact, and they're going to have to figure that out. Part of the Biden's infrastructure plan is actually to get back and start looking at bringing some of that back here, building out the U.S. semis, and so it definitely has an impact, and that pushes to prices, which pushes to inflation.
Okay, terrific. You talked about cryptocurrency. You talked about the IPO of Coinbase. Do you have any further thoughts on this crypto craze that's catching the headlines or the NFTs? You want to?
Yeah, I would say certainly be careful with it. I think there's a lot of those coins out there that have function and they make sense. I talked to a friend of mine and that invests in it, and she's always saying, look at function. What does it do? What does it do to make the world better? I mean, there's some out there that work the supply chain. Companies like Louis Vuitton, they can track their shipments. Amazon will start working with them because now if Amazon starts doing pharmaceuticals, they can track that and make sure it gets there. So a lot of that to the blockchain makes a lot of sense. And that one chart I showed you earlier, there's going to be more and more digital transactions. I mean, there's just it's a way to track money better. It's a way for less money laundering. Well, I shouldn't say it's a better way for money laundering, but it's just we're going that way to more crypto. Now, currency, and there's other ways to look at it too beyond just the currency. I think right now a lot of those are tough to use as a currency. They're too volatile. You can't have stuff moving like that. That's almost like inflation in a lot of these countries.
Okay, terrific. I don't see any other final questions from anybody. I think you did a great job answering that. Do you have any final comments before we turn it over to Andrew?
No, I would just, I mean, I do. I mean, I would just say, as I mentioned, you know, there's always going to be someone saying this is a top, and there's always tops, and there always, as things move up, there'll always be a new top. So certainly if you sit down, put a plan together, if you're an investor, you should be looking at a 5-10 year horizon, 10 years at least to be investing in equities. So yes, there's going to be some bumps along the way. However, what is that goal? What am I getting? What am I aiming towards? Where do I want to be? So then you're less concerned with valuations. So that would be my kind of final words.
Okay, well, terrific. Well, thank you so much for your time today, Morgan, and appreciate all that you put into this. With that, we'll go ahead and turn it over to Andrew for the most important part of what we do.
Yeah, thanks. And along the lines of what Morgan was saying, I mean, despite all the numbers that we discussed today, great returns, great GDP numbers, a lot of people have missed out on that. We still find that people are falling into the same old traps. They're chasing fads. They might be picking stocks. They might be timing the market. Like a lot of people who sold in 2008, 2009 and waited years to get back in, or even selling at the bottom of this latest pandemic. Through the decades, they seem to be the same mistakes that people keep falling victim to. So these investors can really hurt their chances of their long-term success and add anxiety to their own life. Investing doesn't have to be that way. So we're here to change the conversation so that people can invest better and live better. So the key takeaway is to allow all these numbers to work in your favor, is to have somebody to help you stay on track and not fall victim to these common mental traps or roadblocks. So let the averages work for you and not against you. Please reach out to us if you need anything. Have a good rest of your day. Thanks for joining us.